Okay. Well, with that, that's the auto space. We're moving on to another interesting discussion and now putting the spotlight on the insurance sector. There's been a lot of news flow when it comes to insurance in the last couple of days. And, of course, a lot of those news breaks have come in by our colleague Yash himself. So let's talk about this. I mean, in terms of news flow, there's the rise in the motor third-party premium. That's what Yash put out, that perhaps we'll finally get an increase in motor third-party after 4 years. Also, there seems to be a bit of a go-slow approach in terms of cracking down on the bancassurance channel, something that became a big story a couple of months back. But now I think the government could be having a new, refreshed view on that. This is all, of course, news breaks that Yash has done in the last couple of days. So let's discuss this going forward with Mr. Raghvesh, who's the Insurance and Capital Markets Analyst at JM Financial Institutional Securities, as well as Nilesh Sathe, former IRDAI member. Gentlemen, thank you so much for joining in. Mr. Sathe, let me come to you. I want to take up the contentious issue first of breaking up the agent network. Again, our colleague Yash's latest source-based inputs indicate that abhi thoda pause hai us pe. Earlier, it started becoming it would have been a massive change if insurance agents could be selling policies across multiple insurers. But I think there was some pushback from LIC for obvious reasons. So that's, I think, on hold for now. But your thoughts on whether this is a big reform that we're pushing back?
In my view, this is not the time to have open architecture for insurance agents. I will tell you the reasons for that. One is the number of agents that we have even today is only 25 lakhs. Considering the insurable population, we know that the penetration of insurance is pretty low. Considering the insurable population, if we consider it 75 crore, 25 lakhs is too small a number to cater to these 300 per agent number which comes to. This number has to go up. One, it gives self-employment. And second is the mis-selling which is happening because there is a lack of understanding of the products by the customers, that may go down. So the question is, should open architecture, as is allowed in case of mutual fund, be allowed in case of insurance? In my view, no. I'll give you the reasons for that. There is a risk of mis-selling going to increase because any company which is giving higher rate of commission, there will be a tendency of agents to sell those products. There will be a loss of accountability as well, because one agent may be doing good business for one company, but if he is found doing wrong things in other company, he will have to be terminated by both. So this is going to be a complex issue. Training challenges are also there. See, today there are almost 70 insurance companies, life, general and health together. If I am allowed to sell products of any insurance company, is it not necessary that I should be adequately trained for all the products of all the 70 insurance companies? That's going to be a big challenge again. So without training, if I'm selling a product just because I'm likely to get higher commission, that is also not good. So this is a product
But sir, the counter argument could be that at some point in time the industry has to mature, and insurance has been, even the mutual fund journey. And then the regulator is going out there trying to segregate distributors from independent financial advisors, the IFA community or the RIA community. So reform is a process. You have to start at some point, right?
Yes. So what has been started? An insurance agent is allowed to sell products of one life, one general, and one health insurance companies. This has already happened. Corporate agents are allowed to sell products of 9 life, 9 general, and 9 health insurance companies. There is one intermediary called IMF. He is allowed to sell products of 3 life, 3 non-life, and 3 general insurance companies. So it's not that changes are not happening. Right? If at all a person is so ambitious that he can sell products of all the 70 insurance companies, he should take brokership. That option is also available.
Okay.
The question is, and this is transition which is going on. I'm not saying it is bad. It is good in some of the countries like Singapore, Australia, it is allowed.
Sure.
But the question is the market matured enough to have open architecture in insurance? Insurance and investment. See, mutual fund products are investment products, but these are quite complex products. So insurance products need a lot of training on every product because every product has got a different complaint.
Yes. So that point is well taken, absolutely well taken. I just want to put up a data point for reference. This year, calendar year 25, has been the year of actually more life insurance stocks than general insurance stocks. Let's look at what the stats say. Most of the general insurers or the standalone health insurers, Niva Bupa -1%, Star Health -3%, Lombard has fallen about 10%, Go Digit has done relatively better, 8.5% up. Now contrast this, so those are either your general insurers or standalone health insurers. Contrast this with life insurance, and that's where it's been a good run. I mean, the gains are ranging between HDFC Life 25%, SBI Life 28%, and Max, look at Max, 38% over there. Relatively, ICICI Pru has been an underperformer this year. Stock's up, it's not up actually, it's down about 2% odd. So let me bring in Raghvesh here on this front. Raghvesh, so let's talk about life insurance. Would you say that the reason behind this rally also is that after a very onerous series of regulatory changes in 23-24, whether it's tax or other regulation, now there seems to be a bit of a cooling off. In fact, our latest story that Yash did was actually saying that the government is now telling banks that you should help with insurance penetration. A couple of months back, there was a fear of a crackdown on the banca channel, on bancassurance. What's your view on life insurers? Which ones do you like? And what's your overall thesis?
Yeah, thanks for having me on the show. So regarding the bancassurance channel, while there have been news breaks, the companies have maintained that they have not received anything from the regulator. That being said, they are focusing on mis-selling. The growth expectations from the banca channel, especially the parent banca channel, has come off for the top listed players. If we see ICICI Prudential, SBI Life, HDFC Life are all bank-led insurers. Now, from here, the base expectation is 10 to 12% growth from the banca channel for these players. These guys over time have also invested in their agency. We are looking at a good 15% kind of growth for, say, an HDFC Life, somewhere around a 12 to 13% for SBI Life, and an 11% growth for IPRU going as they finish FY26. This is on the top line front. On the margins, last year we saw very strong sale of ULIPs, which is the lowest margin product. The natural demand came in with markets being strong. The expectation is FY26, we see the demand for more of return guarantees, which is margin accretive for the insurers. So when we are looking at teens VNB growth, I think the life insurers are well placed to move further on that rally.
All right. Hi, Raghvesh. Good morning. Good to see you. I wanted to focus on, the motor third-party insurance hike. That's something that my colleague Yash was working on as well. So in your estimates, what are you factoring in terms of the potential hike that will finally be approved by the Ministry of Roadways, point number one? And what's the sensitivity analysis you have with regard to its impact on the combined ratio?
So in terms of the growth impact, so taking ICICI Lombard, for example, around 40% of the business comes from motor, almost evenly spread between third party and own damage. Now, if we assume, say, an 18 to 25% hike in premiums, which is what was in the news, I mean, that translates to something like a 4% hike on growth. Now, the industry growth itself has been pretty weak. That being said, there is an impact of the regulation change. Like last year, the reported growth for the industry was somewhere around 6%. Actual growth, if we remove the impact of the regulation change, was around 8.5%, 8.6 to be exact. Now, what kind of TP price hike I am baking in? My base case assumption was no TP price hike. Expectation was if it was to be announced, it would have come in April and May. Now, if I were to take a 4% higher growth for Lombard, what we have generally seen is a hike in motor TP would result in some cooling off in the pricing for, say, a motor OD product, with insurers broadly maintaining their combined ratio. For a company like ICICI Lombard, I think they are comfortable on their combined ratio at 102%. They would like to bring it lower. I think the combined ratio does not materially improve. Even if there is a price hike, they'll invest it for growth. My base case assumption is somewhere around a 13% growth for ICICI Lombard for FY26, increasing to say a 15% growth in FY27. My base cases, the growth numbers increase as they spend on acquiring new business.
Okay. All right. Got that point. Thanks very much, gentlemen. Slightly shorter discussion, but important developments, all of this, whether it's, the relevance of the banca channel, whether it's open architecture, or, of course, those long-awaited increase in premiums on motor third party. Thanks very much for joining in.